Hello everyone, I am Sarvit Mandal from PIBM, and in today's presentation I will analyze 8 case studies that demonstrate how SHGs, self-help groups, promote financial inclusion, social empowerment and institutional integration, while also highlighting their structural limitations. So there are some questions that I discuss in this video. So let's start with the first case study, that is based on financial inclusion. So the case study is in a rural village. Most households operate outside the formal banking system. Women rely on a cash saving kept at home and borrow from money lenders during the emergencies. With facilitations from a loan NGO, an SHG is formed and opens a group bank account. Members begin regular savings and later access a bank loan under the SHG Bank Linkage program. For the first time, members interact directly with a bank. So there are two questions that I want to discuss with you. How do SHG act as entry points into formal finance? SHGs function as an institutional bridge between the informal rural households and formal banking systems. They aggregate small savings and open a group bank account, builds transactions history and credit discipline, reduce the documentation and procedural barriers, enable first time interaction with the banks. Instead of individuals approaching bank alone, the group negotiations collectively. This reduces the psychological fear and informal asymmetry. Thus, SHG convert financially exclude household into bank linked participants. Now the second question, why is group based inclusion more effective than the individual inclusion for the poor? So group based inclusion works better because banks face lower transaction cost, one group account versus the many individuals. Peer monitoring reduces the default risk. Social pressure reduces the substitutes the collateral, and members gain confidence through collective participations. In low income settings where the formal credit history is absent, social capital becomes financial capital. Now move toward the second case study. So this is based on savings led inclusion. So there is a question, why is saving is central to financial inclusion through SHGs? So savings are foundational because they create internal capital before external borrowing, build financial discipline and planning habits, reduce the vulnerability to small shocks, and improve credit worthiness. Savings led models ensure that inclusion is based on asset creation, not debt dependence. Now the second one, how does saving change borrower behavior? So regular savings encourages the future oriented thinking, reduce impulsive borrowing, improve money management skills, increase the confidence in handling finances. Borrower become financially responsible participants rather than debt dependent individuals. The next one is on credit access and reduction of money lenders dependence. So there are questions, how does SHG credit improve financial inclusion outcomes? So SHG credit improves outcomes by offering affordable and transparent loans, providing flexible and repayment terms, ensuring local accessibility, creating dignity in borrowing. So it reduces the exploitation and formalizes the rural credit systems. Now the next question, why does the group based credit reduce the default risk? So see, because social accountability discourages intentional default, members monitor each other's financial behavior, and early intervention prevents the repayment crisis. Also collective reputation is a stake, so the risk is distributed socially, not individually. Coming to the, so in the case study 4, that is social inclusion through women empowerment. So there is a question, what social changes resulted from SSG participation? So SSG participation led to increased self-confidence, greater public mobility, improved decision making power at home or households, participations in community and decision making, and economic participations translated into the social empowerment. Next question: why does social access to financial strength women's social position? So, because control over income increases the negotiation power, financial contributions earns respect in families, group identity reduces the isolation, participation builds leadership skills. Income is not just economic power, it is a social leverage. Coming to the next case study 5, that is collective identity and voice through SHGs. So there is a question: how does a group membership strengthen the social identity? So the group members build solidarity among the marginalized households. It creates shared purpose. It reduces the fear of authority. It enhances the recognition by institutions. So the collective identity increases the visibility and legitimacy. Next question is: why is collective voice more effective than the individual action? Because it reduces the power of imbalance, it strengthens the negotiation capacity, it attracts attention of local authorities, and also it protects individuals from the retaliation. Now the power multiplies when it organized. Next, the case study 6, that is education, awareness and behavioral change. So there is a question: why are SHGs effective platforms for spreading the awareness? See, because meetings are regular and structured, and also the peer influence improves the acceptance, trust encourages the open discussion, and information spreads quickly within a social network. So the SHGs function as a grassroots information channels. Next one is: how does awareness complement financial inclusion? See, awareness ensures responsible use of loans, better health and education outcomes, improved productivity and income stability, and also it reduces the legal exploitation. Financial inclusion without awareness may lead to misuse of credit. Moving toward the case study 7, that is institutional support for inclusion. So why is institutional support is essential? Institutional support provides structured credit linkage, it offers training and financial literacy, it ensures regulatory monitoring, and also it connects SHGs to market and livelihood programs. Without institutions, SHGs remain small and informal. National NABARD is critical in scaling the SHG bank linkage model. Next is: what risk arise in institutional coordination is weak. See, weak coordination can lead to uneven SHG quality, regional disabilities or disparities, overlapping credit exposure, poor sustainability. Inclusion become fragmented and inconsistent. Now the case study 8, that is financial inclusion without the social inclusion. Why did financial inclusion translate into the social inclusion? Patriarchal norms remained dominant. Women lacked real control over the loan usage. Participation was symbolic rather than empowering, and the decision making power remained unchanged. So the access does not automatically equal authority. And the last question is: what does this case reveal about the limits of financial inclusion alone? It reveals that access to credit is necessary but not sufficient. Social norms must evolve alongside a financial system. Empowerment requires behavioral, cultural, and institutional change. Inclusion must be multidimensional. True development combines economic access with social transformation. The SSG model demonstrates that financial inclusion is most effective when it integrates saving discipline, collective responsibility, social empowerment, institutional support, and behavioral change. However, financial access alone cannot guarantee social transformation. Thank you.